How did Netflix do, Steve?
Yeah, okay, so in the interest of disclosure, I don't own this stock either, for what it's worth. But I think we discussed this a few weeks back, actually. A few weeks ago, Steve and I were talking about portfolios and so on. And I think one or other of us said and the other agreed, but we were both thinking, I can't remember who said it first, that this looks like a company that's turning itself into a cash generator at about the right time, with interest rates going up. Mm-hmm. This earnings report kind of bears that thought out to me a little bit. This looks to me very much like a company in transition. It's going from a kind of story stock to a kind of money stock, the kind that you need a bit more vision to see, to the kind that you can kind of read the numbers off a little bit. But let's start with some numbers then. So revenue of 7.93 billion versus 7.837 forecasted, which was a slight beat and up by about 6%. Earnings per share with $3.10 versus $2.13, so a big beat. I've got that written down as down 3%, which I feel like must be wrong somehow. But okay, cool. I'm correct here. But as I was saying, so far this hasn't really been a revenue and earnings stock. I couldn't tell you what they were over the last couple of quarters, but I can tell you why that stock has been going down and down and down. It's because subscribers have been going downwards and not upwards. They were expecting it to turn around this time with 1 million new subscribers. They actually got 2.4 million new subscribers. Most of those came out of Asia Pacific and EMEA, which we'll come back to in a moment because I had a thought of a sort on that for you. But they said they're going to add another 4.5 million by the end of the year. So if you were interested in kind of counting subscribers and seeing that as a kind of barometer for how the company is doing, it's now started doing very well again, having done, I think it's fair to say, reasonably poorly for the last couple of quarters, if you're measuring by those metrics. Going forward, it's going to turn itself into a numbers story. I think as of the end of next quarter, they are doing away with guidance on subscribers and numbers. They are going to keep giving guidance on revenue and earnings and margins and so on and so forth, but they're not going to start guiding for subscriber numbers anymore because they see themselves as a cash generative thing. The ad-supported model that we were talking about is coming out in November, so kind of halfway through a quarter, which makes it a little bit hard to detect what the exact impact of that will be. The password sharing opposition is coming in 2023. So that's the broad outline of things. I have some thoughts which we'll come back to in a bit, but what did you guys think of this?
So the revenue guide, just to let you know, that the revenue was down because of, almost entirely because of FX. So it was actually about a 10% swing, but because they make so much revenue outside of America, repatriating that money obviously cost them a lot. So they went from what would have been between 8 and 10% growth to -1. So, but I mean, we've probably all felt that in our portfolios with American dollar at the moment. I thought, they want to turn themselves into a revenue and earnings company. They physically stated that in their comments that they're not going to guide on subscribers anymore. They're going to report them, but they're not going to guide on them because they want you to focus on the actual business metrics, which is smart, really, because I think subscribers is starting to slow. I think we would all agree that it slowed down a little. And don't be fooled by them saying they're going to add 4.5 million new subscribers on. Billion, that would be good. Million new subscribers. I think a lot of them are going to come from the end of this account sharing and potentially some from the ad tier, maybe bringing some people back. But the vast majority, I would imagine, is this feature. Really, really smart of them. They've introduced a profile switching service as well. So if you split up with your wife, Steve, and you want to take your Netflix, your perfectly curated Netflix account with all its recommendations. And
why would you think we pay for our own Netflix and me and my wife?
Well, you can then switch your profile out, and you won't lose your perfectly curated content. And it's funny how this has arrived just in time for this new profile series, this new password sharing thing to stop. But yeah, I was really interested in the free cash flow numbers as well. So they're still going for that billion free cash flow. They think they'll do a lot more than that next year as well, even though they've got a little bit of higher capex to come. And I was interested to see that a lot. One of the things we discussed was that moving on to the ad tier could be detrimental to Netflix's top line revenue and obviously their profits. And they've said that they actually think that this will be neutral. So if you downgrade from a premium package to their ad tier, they think even straight from the bat, even before they get to crank up the ad load on you and charge more for the adverts, that they think that you will be neutral. And this is because people consume so much stuff from Netflix. released a few stats, but essentially you consume 2 times more Netflix than you do any of the other streaming services at the moment. And that's great when you're introducing an ad tier, when volume really matters, which it does with an advertising service. Netflix get a hell of a lot of volume. So I thought they were really good results. I thought this is the turnaround of Netflix. You can quite clearly see where the growth is coming from, and if that growth filters through to the bottom line, I'm less interested in Netflix's bottom line because of the way they deal with content on their balance sheet. But I am more interested in seeing that free cash flow figure crank up and up and up. And like they say, there's no proof on it because those numbers are not exactly broken down. But Netflix is the only company doing this at scale at profit at the moment.
Yeah, absolutely. This is great. What I don't like on Twitter at the moment is this has been a bull versus bear fight, and I don't think it ever has. I think everybody agrees that Netflix has always had a brilliant brand. This is slightly being disrupted. Their model's slightly being disrupted because there is competition coming in, so it is something you still need to think about. But you still need to understand what we've got right now is Netflix at a really good price, haven't we? Bill Ackman has sold Netflix at a really, really good price. And that was the time to really start thinking about Netflix. When the price had come off, when the price that had been priced to perfection started to show some of the kinks, it got corrected and then the price came down to the where we wanted it to be. And now we're at this really nice place again with Netflix where we are seeing the growth, we're seeing this money making machine start, we're seeing customers coming back. This is great. This is where Netflix was, but nobody knew where that was, where that price was for Netflix to be perfectly within its valuation. But it seems like we might be seeing it here. What do you think? Are you still buying this at this price?
So, just to go back to Ackman before I answer that, Ackman did have a stinker. It's 30% higher than the price Ackman sold it at, but remember it did fall about another sort of 20% after Ackman sold it as well. So it's actually 60% off the bottom. So anybody who's bought it sort of within the last 3 or 4 months has done remarkably well off the back of it. I have bought it in that period of time, but I am actually still down even after this run up. But I'm only down about 2% as of today. FX is giving me it's giving me a little tickle along. But I started buying this before Ackman. But unlike Ackman, I have continued buying it because I just thought it was just far too cheap. Even if it was going to convert to being a cash generating company, it was trading at 15 times earnings, cash flow a little bit spottier, a little bit heavier, but it still looked like it was really good value to me. Just another thing, Paul, actually, this is another thing I want to pick you up on as well. You always say that Netflix has always sort of lagged behind Disney because it doesn't have the IP. They released some stats on that, so they must have been listening to the podcast and thought, we'll get this guy. 10 years ago, they had zero IP, they had zero library, and they basically said, we need to build a library of our own IP. People told them that would be impossible. It was a 10-year plan. They said it's impossible to build IP over 10 years. Their IP is now getting more revenue and more profit than all of its competitors, they reckon. So that was a quite important stat that I saw.
How are they measuring that?
Just through the streaming services, obviously. They can't do comparison with Disney that has a theme park dedicated to Marvel. But yeah, over their literal IP streaming, like-for-like library, they're generating more revenue and more profit through watches of their own IP than the competitors, which I thought was particularly interesting.
Yeah, I wonder what people are going back to watch. I can't think of any Netflix shows that I'd be going back over to watch again.
Maybe Stranger Things. Maybe people
maybe
watching that from the beginning again.
Squid Game, I might watch Squid Game again. That was quite entertaining, wasn't it?
The shareholder letter usually lists things that have been going well or what they're particularly proud of in their most recent quarter. I would guess the answer's probably in there, although I skipped past that bit of it. I think this is basically a story of the kind that Steve was rightly seeing a few weeks ago, and I think I was sort of seeing with him, but I didn't put my money there, so my view doesn't count. in that, look, it's a company that had everything going against it at one point in time, and wasn't going to take an awful lot to go right for it to kind of turn around. I think a fair bit's gone right. There's still plenty more to come out of this from what I can see of it. So, a couple of quick thoughts here. Those subscribers, I said, were mostly coming from Asia Pacific and EMEA kind of regions. The kind of average revenue from those is much lower than it is from the States and Canada per user, and I think that's kind of significant. I was listening to the Motley Fool on this, and Tim Byers was saying he thinks that's basically because the States and Canada is saturated at the moment by Netflix, so they're not going to grow there. I don't buy that argument. They've lost almost 2 million subscribers there over the last couple of quarters. I'm not sure why they couldn't be got back again. I'm not sure they've all just emigrated and gone off to Asia Pacific region or something like that. So I think there might still be capacity to get those back again. I view that positively for what it's worth. I view that as kind of upside for this sort of thing, and there's still growth available in that market that isn't there before. I don't buy the thought that means it's saturated, and that's why you shouldn't expect to see growth there, though. The other thing is, I was looking at their cash flow statement, and crikey, that's a busy cash flow statement for a company that has operating earnings at one level. And so basically what you do with a cash flow statement is you take your net income, add back all your non-cash adjustments, and that gets you operating cash flow. Take out the capex, it gets you to free cash flow. And there's a lot going on in the add backs in that kind of thing. There's an awful lot of amortization going on, as you would expect with a company that owns a lot of kind of intangible IP, brandy related stuff, or franchise kind of stuff. There's also an awful lot going on in content spend. They're still spending about $4.5 billion or so on these things from what I could see of it. And you might have answered my question already here, Steve, for what it's worth, but I kind of have an ongoing thought in my head of when does this stuff slow down? I get that's their moat, I get that's what they use to stay in front, but it feels like quite a lot of cash goes out the door still with this company on building out further IP franchise titles, that sort of thing.
Yeah, well, that was the thing that's always sort of worried me, was that CapEx eventually has to sort of level out, and it actually has leveled out over the last year. It leveled out about 17.9 billion, which is oddly 4 times what you probably the number you just given me.
Pretty much,
so,
yeah.
So yeah, it definitely has started to level out. I mean, the law of big numbers, you're going to get to a point where you can add 3 or 4 billion to that number and it doesn't look exponentially bigger than 3 or 4 years ago. So I think we are approaching a period where, I mean, Netflix has got plenty of content, and the content that comes out, especially over the last sort of 6 months since we've had this refocusing of what Netflix wants to be, has been a lot better. So I think capex wise on shows, I wouldn't imagine it would be too much higher than this. It depends what the others do, doesn't it? If Netflix is not going to want to get into bidding wars for new shows. They like the method that they've got at the moment, where they can turn up to any book fair in the world and buy pretty much any show they want. So they're not going to want to get into bidding wars. If that happens, then the capex spend is just naturally going to go up. The other thing I was going to say, which I completely forgot about, is Netflix is a big company. It's a big company driving a hell of a lot of revenue. So for them to pivot like this to what is essentially a new strategy is impressive, and the speed in which they've done it. Basically, they started talking about an ad-supported tier less than 6 months ago, and it's already here. So they need to be sort of commended on, what 6 months ago this was a dead company that was that had finished growing. That was the end of it. Blah 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 blah. They've pivoted to a new strategy, which is going to unlock a new arm for their business. So that does deserve commending. That shows you. I mean, Reed's been told he's a wartime CEO. I think he kind of is coming across as somebody who, like, when the going gets tough, he really knows what he needs to do to kickstart this. But on to Tim Byers at Motley Fool, I think he's been really short-sighted. I do think America is saturated, but Netflix have turned around and said, well, look, let's stop profile sharing, because if the US is saturated, the US drives the vast majority of our revenue. And one of the ways to sort of unlock that saturation is to stop people sharing accounts, and that should start to get that bit growing. There'll be initial people who say, "Look, I'm not paying for this crap. I'm just going to cancel my account and I won't do anything." Blah blah blah. But they'll come back if Netflix's content is still good. They'll start to drip back into that. If they only need to move some of those customers onto their own account, and that's a win for Netflix. Even if they move on to the ad-supported tier, it doesn't matter what tier they move on to, that's a win for Netflix. And if they can drip them on over a period of time, you can just literally plot Netflix's revenue going up on a graph almost.
It's definitely one extra subscriber each time, and it's kind of a no-lose situation. I really can't see a situation where they stop the password sharing and both people on the end of the password sharing cancel their subscription at that time. I just don't see it happening. I think the draw to Netflix is too strong. But what it does do is it makes that other person look for something else. That person is obviously going to look for a deal somewhere. At the moment, I can't doubt that the Netflix ad tier is going to be a good deal. I don't think I can't tell you the figures right now, but I don't think it's 100% a brilliant, as in better deal for the consumer as, say, free cable TV is. I don't think it is, but I think there's still competition. I think we still need to look at it. I think Tim Byers has been very short-sighted there. I haven't heard it myself, but I do think that is short-sighted. I think to take such a strong opinion of the competition in this market right now is I think it's too much. I think you still need to be open to it, and I think that's what the share price has done. I think the share price has shown that openness to the possibility of competition here, and I think the market is fairly pricing at the moment because of that.
Wasn't expecting you both to agree with me on my stance on the UCAN stuff. Concerned I might have misrepresented his position now because I only listened to it quickly. So go check out the Motley Fool's podcast on this, by the way, if anyone's interested in hearing what someone who's actually qualified to talk about this stuff wants to hear.
Yeah, no, Netflix is obviously really good. It needs to keep it up, and that's the only. I can only talk sort of anecdotally and say it feels like these companies are just on a treadmill of constant content production. At the moment, they're throw it at the wall and see what sticks kind of works. I don't know what's stopping the other companies from doing that. I think HBO has said it wants to go more quality all the time, so it's going to hire in the talent to write the quality, so that kind of discounts that one, but it doesn't stop places like Comcast and Peacock bringing that in. It doesn't stop Disney bringing that in, which I feel like they could start doing as well. Just throwing any old crap at the wall.
It would be frightening to do it, though, wouldn't it? It would be frightening for somebody like Comcast to just say, right, we're going to do 18 billion on content now, and people go, whoa, we don't have that many subscribers. You know, how are you going to pay for this? You know, it's frightening. I think Netflix has the luxury of being able to do that because
you're right.
Yeah, because
you're absolutely right.
Because it generates that it's profitable. I guess that's their argument, is saying that, look, all these competitors have come, all these people you said are going to come and beat us up, but the thing is that we have the leverage in that we have the business that can withstand these costs and still generate a profit, whereas these other companies, they would have to cannibalize a different arm of their business to generate the money they need, and as we've seen with companies, they're not always willing to cannibalize some business, or to sacrifice part of the business, or to sell off part of the business, or to take the debt on, or to do anything really to risk 18 billion, to compete with Netflix. I mean, I wouldn't be in a rush for that. Disney's a bit different. It's going to spend around that kind of money on content, but they're not really battling for any content. They've got this massive IP library, and it's just about them sort of getting that content made and out there for the vast majority of it.
And also, something worth noting is Disney and Hulu have a very strict no password sharing system in place already, so they won't have the power to unlock that later. Maybe they could start doing a bit of a password sharing thing, and that could be a key to drawing out a couple of Netflix subscribers, maybe, kind of advertise it a little bit. That might be an interesting advert to go out there, say, share our password. We don't have a problem with it at all, but this company does. Like one of those sorts of ads that I could see running around could be an interesting. I'm not trying to find problems, but I think it's going to be very interesting to see how this. We say it every single time. It's going to be very interesting to see how this whole streaming system works against cable, against each other, and the future has. It's very hard to tell, isn't it?